Well, welcome everyone to this year's A&A update. My name is Michael Hoos. I'm a director in our professional practice uh, department. I am based out of the Raleigh office, and I spend most of my time answering technical questions and developing content like this, and then doing a little bit of quality reviews, that kind of thing. And with us today, we have Alex Wiley.
Yep. Thank you, Michael, and everyone. Like again, my name is Alex Wiley. I'm a director in our county advisory group. I sit here in Charlotte, and my focus is on technical county, what I call a project solution co-sourcing group. Look forward to welcoming everyone. I know we have a lot of content to get through, so look forward to it.
Yes, and as Alex mentioned, we have a lot to get over today. So today, these are your learning objectives, and really, these three things are just different ways of saying we're going to teach you all of the ASUs that you need to know for your 12/31 2024 reporting period. And then probably mention a few that maybe you should consider early adopting, but at the bare minimum, going over the ones that you absolutely have to adopt for 12/31/24. Let's jump right into our first polling question.
Yeah, and I'll get you started. I know everyone here is A, for the understanding for the learning, but B, really for the polling questions. The very first polling question: has your organization already assessed the impact of the latest ASUs? Couple answers: yes, we have everything under control. Second answer: yes, we have started but need help and guidance. Third answer: no, but plan to get started next few weeks. Fourth answer is I have no idea there are updates even coming. We'll give you a moment to answer those polling questions and we'll get started. I know there's a lot of questions that may come up throughout the engagement. Michael and myself will use these polling questions time to try to get through these questions. Obviously, the most important thing is us to get through this information. So if we're not able to address all your questions that you put in the chat, there will be a contact screen to at the end of this polling, at the end of the webinar, that has both Michael and I are contact, and we're more than happy to talk to you afterwards. All right, looks like the polling results in, Michael. Looks like we're almost evenly split with the 30% coming in and no, but plan to get started in the next few weeks. So sounds like this is a great timing for everybody.
Excellent. So we're going to start off, just to kind of give you guys a little bit of a background on how this is going to be organized. We're going to start off with ASUs that are effective for public entities, and myself and Alex will speak on a couple of these. And then we're going to move into ASUs that are effective for private entities, and then lastly, those you should early adopt. But don't fall asleep just because we're talking about public entities right now, and you might be thinking, well, I'm part of a private entity. What do I need to pay attention? Well, for one, you're going to need to pay attention because, well, eventually these are going to have to be adopted by private entities. And then two, the other reason why you're going to want to pay attention is because some of these we might suggest that you early adopt. And so it's worth paying attention to even the public company ones if you're a private company auditor. And so you can see the ASUs that are effective for this coming calendar year end. So I'm going to talk about the first couple ones here, and then Alex is going to take over. And so the very first one we have is ASU 2020-06. And this one is the deals with debt, particularly debt with conversion and other options. And so what this ASU did, and hopefully many of you have early adopted it because it's something that we've been suggesting folks early adopt. What it did is it eliminated the beneficial conversion feature. And so for those of you who didn't know, if you had debt and it converted at a rate that was, say, below the market rate, so you get more shares than you otherwise would, you would have a beneficial conversion feature. You'd have to separately account for that. And that kind of became onerous. And so this ASU eliminates that, but it also does some other things that are a little bit hidden that maybe folks haven't realized, and it can be impactful to you, especially you private entity auditors. It also has some impact on EPS. So you see here some EPS clarification, requires the if converted method to be used, and requires the potential share settlement be shown in diluted EPS if there's an option between share settlement and cash. And it also adds some other disclosures that are pretty, self-explanatory, like what conditions would cause a conversion, who controls them. The one thing it also does is it clarifies that the fair value disclosures. Now, for those of you who are private auditors, accountants, the public companies have to disclose the fair value, even if something's not recorded at fair value. There's a footnote disclosure requirement, and so what this ASU does is it also kind of one of the hidden ones is it clarifies that you have to separately disclose the fair value on an individual convertible instrument basis. So, one of the things that people didn't like about the BCF guidance is that, or embedded derivative guidance more precisely, was that you'd have to record things at fair value, and that costs money and time. So, the FASB's definitely tried to get rid of having to measure things at fair value, but when you still have to disclose the fair value, it makes you wonder like how helpful it's going to be. It also removed certain criteria that had to be met in order to be classified as equity under 81540. And so there's a whole bunch of onerous rules about whether or not you have to record something as a derivative liability. And there's certain criteria. The ones that are no longer with us are the settlement in unregistered shares. So you had to have settlement in unregistered shares to be equity. There could be no collateral requirements, and there were no shareholder rights that ranked higher than common stock. And so that all went away, and so those criteria are no longer required to be classified as equity. And then the big one that I think is kind of hidden is the second one here, and that is that this clarifies that regardless of whether an instrument meets the definition of a derivative, it has to be remeasured at fair value each reporting period if it fails either of the indexation or settlement criteria in 81540. And so to give you a little bit of background, no one wants to account for something as a derivative because then you have to get a fair value every reporting period, right? And so what would happen prior to this is many private entities would say, my shares are not freely tradable, right? I can't go to Yahoo, and trade them. So because they're not freely tradable, they're not readily convertible to cash. Now, that's important because if you're not readily convertible to cash, then you don't meet the definition of derivative. And so private entities logically thought, well, then if I don't meet the definition of derivative, why would I count for something as a derivative? That doesn't meet the definition of a derivative, right? And so that was the logic as to why folks would say, yeah, maybe it fails 81540, but because it doesn't meet the definition of derivative, because it's a private company stock, I don't have to pay attention to 815. Well, what this clarifies, and I think honestly this is the biggest change that's a little hidden in it, is that no, even if you don't meet the definition of derivative, if you fail 81540, the indexation or settlement criteria guidance, guess what? You have to account for it basically as a derivative liability, whether or not it meets the definition. There's also some minor clarifications that it has. And of course, this was something that was required for all public business entities to be adopted a couple years ago. But now for smaller reporting entities, that is now required to be adopted for our December 31st, 2024 year end. And then also, another reason why you should pay attention, even if you're a private auditor, a private accountant, is that public companies are now required to apply this as well. Early adoption was allowed, and you have basically the full retrospective, modified retrospective, transition methods. So that's the first ASU. The next one we're going to barely even talk about, and this is several ASUs because it's the effective date was extended, and this was reference rate reform. So if you recall, LIBOR, the London Interbank Bank Offering Rate, that went away. Right, there was a big scandal, and so that went away. And now we have things like SOFR and other methods. But what we don't have is LIBOR, and so a lot of these agreements, debt agreements, lease agreement, anything that had LIBOR in it would have to change. And so the question was, well, if it changes, does that mean I have to de-designate my hedging? Does that mean I have to go through like extinguishment versus modification accounting, that kind of thing? And what this ASU did is it basically said if all you're doing is changing the reference rate from LIBOR to something else like SOFR, you're okay. You don't need to. It's a non-event. It's like a novation, right? You're changing some terms on it, but there's no accounting impact. But it just has to be over changes that occur before December 31st, 2024. And so That's why it's on this list here, is that it has a weird effective date. Most effective dates are like, hey, you have to do this in the future. This effective date was, because of the nature of it, hey, you can't do anything past this date. Now you have to account for it as a modification or extinguishment if you're replacing the reference rate. And that just ends on December 31st, 2024. That's all this that you really need to take away from this. Hopefully, most of you have already adjusted for your reference rates. And with that, we'll hop on to 2022-03 and let Alex take over a little bit.
Thank you, Michael. Guys, the way I like to approach when we get new standards, new updates, I really like to start with the why and the purpose. And I think if you understand the purpose of what FASB is trying to do and the why, it really helps the content. So when you look at ASU 2022-03, fair value measurements and equity security subject to contractual sale, the purpose of this guidance, right? It clarifies the guidance in ASC 820 on fair value measurement of equity securities that are subject to contractual sale restrictions, as well as update some of the specific disclosures related to such securities. And we'll talk through this here shortly, but that's kind of the purpose of what this standard is doing. And what is the why? As noted, this standard or this update clarified that a contractual restriction on the sale of an equity security is not considered part of a unit account. And what does that mean? That hinges on which restrictions are characteristics of the asset versus which restrictions are on the entity that holds the asset. The reason, the why FASB issued this new standard under the current guidance, there was some divergence in practice. We had stakeholders as well as practitioners. We had some who would use a contractual sale restriction as a discount or use it as part of measuring fair values, while we had others who did not. And so obviously the primary reason for this update is a contractual restriction should not be considered when you're measuring fair value. And what do we mean by contractual constriction? Something as a liquidity discount for lack of marketability. Those type of contractual restrictions that you may read in type of certain securities no longer impair you from determining fair value of that security there. The other thing that this standard does, there are new requirements for filing disclosures. There are fair values. This standard does require, this update requires that all fair value equity securities be subject to contractual sales restrictions. You're now required to disclose that. You're also required to disclose the nature as well as the remaining duration of those restrictions. Last but not least, you're also required to disclose the circumstances that could lapse the lapse in this restriction. Next slide, please, Mike. The effective date for this particular standard for public entities for annual periods beginning December 15th, 2023, as well as for interim periods beginning after December 2023. For all other entities, the effective date is December 15th, 2024 for your annual, and for any of you non-publics or they may have interim reporting periods, December 15th, 2024. It is early, it is allowed for early adoption. One thing I will point out here is any investment companies under 8946, your effective date is prospectively for any equity securities that are executed or modified after adoption. And then for all other companies, it's prospectively for all equity securities on a go-forward basis. Next slide. Again, the next standard here, ASU 2022-04. Again, we want to start with the why. Obviously, this particular standard was enhanced transparency that an entity uses supplier finance program. What we found in practice is prior to this actual standard going out, there really wasn't any guidance out there in place on how to treat a supplier finance program. In addition to for those companies and practitioners who were presenting or who were involved in supplier finance obligations. One thing we noticed, there was some divergence in practice on how to present this on the face of the balance sheet. Did it go into the payables line item? Did it go into the other borrowers line item? This particular standard here clarifies A, how it should be disclosed, and B, what should be disclosed. So let's move into what does this standard says. The standard, my apologies, Mike, if we go back, thank you, sir. This standard covers a buyer and a supplier finance program must disclose sufficient information about the program to allow the users to understand the program's nature, the changes in the program and the potential magnitude, as well as the activity under the program. I think the key here is really in the qualitative and quantitative disclosure requirements. You're now required, if you're part of a supplier finance program obligation, you're required to disclose the key terms. What are those key terms? Payment terms, assets, pledges, and securities. You're also required to disclose a roll forward. The obligation is outstanding. So beginning balance plus or minus activity gets you to the ending balance. The good thing about the roll forward, the good thing about this particular standard is if you have questions or need examples of how that roll forward looks within disclosure, there are examples within the standard themselves. Thank you, Michael. Again, effective date, this is for all entities, fiscal years beginning after December 15, 2022, except for the roll forward requirement starts after December 15, 2023. And again, this standard does allow early adoption. The transition method for this standard is retrospectively, except again, the roll forward requirement should be applied prospectively. Next slide. Next slide, my favorite, leases. For some of my clients who are out on the call today, they understand exactly how I love lease accounting. This particular standard actually is covering 2 items, and we'll talk through each of these items here. But topic 842 requires that the entity that determines whether a related party arrangement between entities referred to as common control and what we refer to herein as common control arrangements, they have to determine if there's a lease. And if you're not, I know this is in the public part of the arrangement or of the webinar, but this is actually for non-public clients. And so what this update says, if that you're a non-public client in a common control arrangement, you now have a practical expedient to allow you to determine if there's a lease between parties. And that practical expedient includes terms and conditions. And those terms and conditions that need to be considered if you go through, if you're a common control between both the lessee as well as the lessor, then you have that practical expedient option to use written terms and conditions to determine if there's a lease between common control arrangements. If there are no written terms and the entity has not documented the unwritten terms, obviously, if you're in a common control arrangement, you have to use legal enforceable terms to determine whether there's a lease or not. And last but not least, this particular part of the standard or update has to be applied on a lease by lease basis. The next piece of this guidance is accounting that this standard is addressing is accounting for leasehold improvements. As we all know, or we may or may not know, under 842, leasehold improvements have an amortization period consistent with either the shorter of the remaining lease or the leasehold improvement itself. Well, this guidance actually goes through and clarify when you're in a common controlled arrangement and you're having leasehold improvements, what period to use if you're both the lessee and lessor. And as you'll see, as if you're a common control lessor and you own the underlying asset of the group, you amortize over the useful life of the leasehold improvement. Whereas if you're a common control lessor and you're leasing the underlying asset, and that's the key difference here between owning and leasing. But if you're a common control lessor and you're leasing the underlying asset, the amortization period may not exceed the life of the lease with the other party within the common control group. The other way to think about that, if you're the lessee, again, if you're the lessee in this common control arrangement, again, as long as you continue to control the actual underlying lease, the amortization period for this leasehold improvement is over the life of the leasehold improvement and not the lease itself. The other piece here to point out, Michael, is leasehold improvements should be accounted for as the transfer between entities under common control through an adjustment in equity. In other words, if there is a lease that's in place between 2 common control entities, if at some point in that lease it becomes leased to a group outside of the common control group, you now have to they no longer control the asset, and there needs to be an adjustment through retained earnings. Next slide, please. Obviously, again, as we talked about, even though this particular slide was in the publics, that is not applicable for public clients. This is for our non-publics. Fiscal years beginning after December 2023. Again, early adoption is permitted. Hopefully, most of our guys out there have already adopted for our non-public clients, have already adopted 842. There is a transition requirement. So if adopting concurrently with 842, which hopefully this should not be applicable for anybody because we know we're all ahead of the game. There are certain requirements for terms and conditions. Next slide, Mike. Go ahead.
Yep. I do want to point out one thing on that ASU, everyone. And that is the part that's only applicable to private entities, right? There's two parts, one that's applicable to private, one that's for public. The one that's on common control is applicable to private.
Hmm.
We've seen in practice a lot of folks get it wrong where they think something's under common control, but it's not. So in order to account for things only according to the written terms, they both entities, the lessee and the lessor, have to be under common control, and common control is different than common ownership. And so the
Yeah.
example I always give the folks is if, I have five owners in a company and each one owns 20%, and they own both companies, the lessee company and the lessor, that's not common control, that's common ownership. In order to have common control, one of those folks would have to have complete control, or they'd have to be some sort of written agreement that at least 50%, 51% of them or more would vote together. So I just want to kind of point that out because I've seen a lot of mistakes folks make with that issue. Go ahead, Alex.
Good point
Sorry.
there, Michael. No, go ahead. No, it's back to you, Michael. That's a very good point to point it out. Thank you. Turn it back over to you, Michael, on accounting for investments and tax.
Okay. Yeah. So the next issue, 2023-02, deals with accounting for tax structures using a proportional amortization method. And so to kind of give you a little bit of the background, as Alex says, the why here, and that is there's these things called the low income housing tax credits. Okay. And what it is it's a tax credit to incentivize constructing or rehabilitating like affordable rental housing units, right, for low income households. And the federal government will issue tax credits to state governments, and those state governments will in turn award these credits to developers, who in turn will sell these credits to investors so they can raise the funds for a particular project. And these investors will make these investments in the developers and this low income housing tax credit, not for the typical purpose that you would make an equity method investment for, right? To earn dividends or return. It's really purely for the low income housing tax credit. Because once that property goes live, I think you have 10 years that you can recognize your low income housing tax credit. And so, if most of you probably are aware that, when you have an equity method investment, whether it's equity method or just an equity security, you have to account for it either under the equity method accounting, which you recognize proportional share of the income, or you have to recognize it as you would any other investment and you just mark it to fair value. And a lot of folks said, look, my investment, even though it's an equity security, is different than, your ownership in Google or Amazon. And so my return is all about this low in the tax credit. So can I just, instead of recording the fair value change every reporting period, can I just amortize this in proportion to the tax credit I get? So my investment, my asset account would be amortized in proportion to the credit that you get for the investment. And that's where they came up with the proportional amortization method. And they said, yep, you can do that for low income housing tax credits. Well, what this ASU did is it basically said, hey, everyone likes this. Let's just go ahead and expand it to all tax credits, regardless of the specific program, right? It doesn't have to be the low income housing tax credit, right? That's the big thing that it did. Now, it obviously has other minor things to it. It removes some onerous specialized guidance for low income housing tax credits. And it gives some criteria that you have to use to qualify. And most of these criteria are pretty self-explanatory. We don't need to go over all of them. But basically, what it is that, substantially all the projected benefits are going to be from income tax credits, right? And so that's basically the biggest takeaway. And also, it can't be an equity method investment. It can be an equity investment, right? Like you would own, say, 10%, but it can't be something where you have the ability to exercise significant influence. They'd still want you to do the equity method for that. And this ASU basically says, hey, you can, apply this on a tax credit by tax credit basis. And it has a few new disclosure requirements as well as most of these ASUs will. Now, for public business entities, this is effective for this coming calendar year end, and it will be effective for next calendar year end for private entities. But again, if you're a private entity accountant, wake up, because this is something that we're going to recommend that you early adopt, because obviously, as you can tell by the nature and the background I gave you, people want to do the proportional amortization method if they have a tax credit. All right, moving on to ASU 2023-07.
I'll
I
take those
think
from
Alex,
Michael.
that's yours. Yep.
Yes, sir. Thank you. And again, guys, like I said, when we're talking about a new update, talking about a new standard, I always want to start with the purpose and the why. I really think that helps us to digest the content. This one here is one of my favorites because I deal with this a lot with some of my clients, but ASU 2023-07, improvements in reportable segment disclosures. The purpose of this amendment is to enable investors to better understand the entity's overall performance and assess their cash flows at the segment level. This particular standard improves the segment disclosure requirements, primarily through enhanced disclosure about significant segment expenses, which we'll talk through here shortly. In addition to that, the amendment enhances interim disclosure requirements. Part of the FASB thinking of enhancing disclosure requirements around segment is not only requiring, practitioners and public entities to disclose annually, but to do those same disclosures on an interim basis. And that's how they're going to enhance that. And obviously, last but not least, this clarifies circumstances in which an entity can disclose multiple segment measures of profit or loss and provides new segment disclosures within this disclosure. So let's go through who is applicable. This is only applicable to our public entities. So obviously for all our participants out there, if you're non-public, this is not applicable to you, but for everyone else that is in a public entity, this is applicable to you. Again, this new ASU does not change the definition of a segment under ASC 8280. It also does not change the method of determining a segment or the criteria for aggregating operating segments into reportable segments, as we talked about on ASC 280. It does not eliminate any current disclosure requirements, as we talked about earlier. This particular ASU is only enhancing. In other words, how they're enhancing? They're enhancing by requiring all the segment reporting to be done both on an interim basis as well as an annual basis. The biggest thing that's changed here, it does require disclosure of significant segment expense categories. The first question you ask yourself is what is a significant segment expense? Obviously, walk you through what qualifies as significant segment expense. First thing to think about it's significant to the segment. I know that's common, but that's straightforward. If it's significant to the segment, it's a significant expense. It's regularly provided to the chief operating decision maker, the CODM. If this is an expense that the chief decision maker is using on a readily available basis, it's considered a significant segment expense. It's included in the reported measures of segment profit and loss. A significant segment expense can be both direct as well as indirect, such as shared expenses, allocated overhead, and interest. Next slide, please. What else is required? It requires to disclose other segment items. And what are other segment items? It's the difference between your reported segment revenues minus your significant segment expenses, which we just went over, and it's been disclosed, minus reported segment profit and loss. If there's no significant segment expenses identified, you're still required to disclose in narrative form the nature of the expenses used by your CODM to manage. In addition to that, we'll talk about this here later on in the next slide, but not only are you required to disclose that, you're also required to disclose the title and position of your CODM. The one good thing about this is, my apologies, one last bullet on the last one I want to talk to, Michael. The one good thing about this particular disclosure, there is no reconciliation required between total significant segment expense and the total amount reported on the financial statement. So I think that's key there too. So FASB is giving you some relief there. Next slide, Michael. This particular issue does update and require multiple measures of segment profit or loss allowed to be disclosed. However, you must disclose in a consistent manner which is included on your financial statement. So however you disclose your expenses on your financial statement when you're doing this segment, the significant segment expenses disclosure, it has to be in a manner consistent with the base. Again, it does clarify that the segment reporting disclosure is still applicable to single reporting segment entities. The one good thing about this one, similar to the financing supplier rate obligations, within the update itself, there are examples of how you will change how the new disclosures are required both on an interim and annual basis. Next slide, Mike. This is effective for all entities beginning this year, December 15th, after December 15th, 2023. And then for interim periods beginning after the next year, December 15th, 2024. Again, early adoption is allowed, and we actually will permit that. And then obviously the transition method is retrospectively. Next question. A couple other items that we want to talk about that this particular standard, this update updates, It requires nearly all of your annual disclosures to be made on an interim basis. Again, the purpose of this is to enhance the disclosures, and FASB thought in order to enhance disclosure is to make the annual disclosures an interim basis as well. The one thing this standard does do, it removes the word restatement and switches it with recasting. Hopefully we all understand the difference between restatement and recasting. We know restatement is a correction of an error of previous information, whereas recasting is just adjusting previous financial data. So this new standard or update requires recasting the previous segment reporting. As we talked about earlier, it does require to disclose the title and position of the individual groups who are considered the chief operating decision maker, the CODM. And last but not least, it requires to disclose how that CODM use reported measures of profit and loss to assess the performance of allocated resources. Next slide. Thank you. Pulls us to our next polling question. I know we're right here at the halfway mark, and so we'll make sure we get through this. But the polling question number 2, if entity only has a single reporting segment, then ASU 2023-07 is not applicable. ASU 2307 is required to be adopted in Q1 2025 for calendar year end. True. It's 2 questions. First question being, if an entity only has a single reporting unit, is it not applicable? The second part of the question is, does ASU 2307, is it required to be adopted in Q1 of 2025 calendar year? First answer is true to both. Second answer is false for the first statement of that question. True to false for the second part of the question. The third answer is true and false, and then last, false and true. So if you're paying attention, hopefully we can get this one right. We'll give you guys a couple moments to answer the polling question. And while we're doing that, we'll also kind of look through the Q&A and see if there are questions out there for the group.
Yeah, Alex, I think that this polling question is a great polling question you came up with, because I think one of the biggest things about 2023-07 is that most folks think, well, I don't have a reporting segment, right? Like, I'm just a single reporting segment entity. This is a ASU that deals with reporting segments. I can just ignore this. I'll go back to sleep, Michael, right? But, as hopefully many of you are answering, the first one is false, that it applies to single reporting units. And so what I actually saw is in the, as Al pointed out, there's great examples in the standard. And I think it's case C in the 55 paragraphs that shows what a single reporting unit entity would show. And literally they word for word will say things like, the chief operating decision maker uses net income as shown on the financial statement, right? Like, it literally just references other parts of the financial statements, but they included it word for word in there in the illustration example. So, I want to make sure, if you take one thing away from this ASU, it's that even if you're a single reporting entity, which most of you probably are, you need to have additional disclosures out there.
Yeah, that's a good point. Even if you are a single reporting entity, you still have to comply with 2023-07. Good. Looks like we got the polling results in. Looks like, again, we're evenly split between true and true and true and false.
All right. Well, with that, we're going to move on to the ASUs that are effective for non-public entities, okay? Which is probably going to be most of you on the call today. But we've already gone over some of these, right? Again, there's a method to the madness as to how we organize this. And we go over public first, knowing that most folks are not with public entities, just because it makes sense. Because as you can see here, the ones in red, we've already gone over these when we went over the public entity requirements. So the only ones that are specific for 12/31/24 calendar year ends that are just for private entities this year is 2021-08 and 2022-01. So we're going to talk about each of these here. So accounting for contract assets and contract liabilities with customers. So again, I love how Alex puts it, let's think about the why. So what it used to be is that when you would buy a company, right, you would have an acquisition or you got bought, you would have to apply ASC 805 business combinations. And under ASC 805, generally you measure everything at fair value. Well, the fair value of a liability, say a liability like deferred revenue, is what it would cost to, essentially fulfill that obligation. And so in the case of some deferred revenue, like let's imagine it's a SaaS company who, has very little, you know, cost to keep the lights on, so to speak, and everything just kind of runs automatically. Well, the fair value of that deferred revenue for that particular SaaS company would probably be very little because there's not much cost that is needed to fulfill the obligation. So what ended up happening is a lot of entities would lose revenue. What do I mean by lose revenue? Well, if I was a company and I had $1 million in deferred revenue, and let's say I was not purchased or acquired, well, that $1 million would eventually get recognized in my income statement. Well, now let's say I get acquired and I have to measure that deferred revenue at fair value, and the fair value of it is much less than the carrying value. Then what ended up happening is you would have this 805 transaction. You'd acquire the company. Instead of recognizing $1 million in deferred revenue, you'd maybe recognize 200,000. And that difference between the carrying value of deferred revenue and the fair value would be lost. It would never be recognized into the income statement due to the adjustment to basis as a result of 805. And so that, one, didn't make a lot of people happy. And then two, it costs money to have a valuation specialist go and value something and use like the cost buildup method to measure deferred revenue or something. And so what this ASU did is it says, you know what, we're for deferred revenue for certain contract assets and liabilities that are within the topic of 606, just when you have an 805 transaction, just measure it as though you know were always the initial originator of the contract. Just recognize it like you would under 606. So going back to the hypothetical I've been running with, if you had $1 million carrying value in the acquirer is likely going to be recognizing $1 million. Now, I say likely, right? Going to this kind of second bullet point. Generally, this, because we're going to record it as we would under 606, not under fair value, that generally you're going to record it at the carrying value. And I use the word generally because it's possible the acquiree did something wrong. They made an error when they recorded their deferred revenue, right? And then just because they made an error doesn't mean you get to carry over that error. And similarly, maybe they have different policy elections within 606 that than the now parent, the acquirer, has, right? So there are reasons why you can't just assume and take the carrying value deferred revenue at face value. But generally, you're going to end up now under this standard having your deferred revenue be the carrying value, right? And they wanted to make sure that folks didn't, analogize this and expand it past deferred revenue or, contract assets and liabilities within 606. So they preface it by saying, look, this doesn't apply to other assets or liabilities, right? We're literally just kind of talking about, accounts receivable, deferred revenue is really what this is getting at. So for public business entities, they had to have already adopted this. And now for private entities, which is why we're talking about it at this point in time, they now have to adopt it if you're a calendar year end entity. The next ASU that we're going to talk about is ASU 2022-01. And this one deals with fair value hedging, the portfolio layer method. So let me give you a little bit of a background here. Again, the why always kind of helps us remember things. So back in 2017, the FASB issued 2017-12, and that affected hedge accounting, right? And it did a number of things, right? But in particular, one of the things that it did that's pertinent to this discussion is for certain lenders like banks, mortgage lenders, credit unions, that kind of thing, they'll enter into lots of fixed rate loans, right? And typically these loans, which are assets to the banks, are funded by floating rate liabilities, right? That's how they get the money to make the loan. And so there's a mismatch between these fixed rate assets, right? The mortgages that they give to normal folks, and then the floating rate liabilities they use to fund these assets. And so that difference between the floating rate liabilities that are used to fund and the fixed rate assets created earnings volatility, right? So you want to hedge that. But generally, in order to apply hedge accounting, right, there's you have to match the maturity date of the hedged item, in this case, the fixed rate mortgage, and the instrument that is being used to hedge, right? And so that kind of created problems when instruments are prepayable, right? Like a fixed rate mortgage, you can go and pay off your home loan tomorrow if you wanted to, for most folks, right? And so, or when there's like multiple items that need to be hedged, like multiple loans need to be hedged. So that created a big, onerous process where a lot of folks felt like they couldn't really hedge when they should be able to. And so ASU 2017-12 said, we're going to create this last of layer method is what we're going to call it, right? And it's basically going to allow you to hedge a stated amount in a closed portfolio. So let's say that you finished your year and you closed your portfolio of all your loans, and you're going to hedge that last layer, the ones that are going to be mature soonest, let's say in 10 years or something like that, right? It lets you say, I'm going to hedge just that layer, and I don't necessarily, even though it's prepayable, that's okay because ASU 2017-12 said it was okay. And I'm just going to do that last layer, right? But there might be other layers in that portfolio that was a little unclear whether I could use that kind of same logic, right? Or if I had to use traditional hedge accounting, which generally meant you'd have to match up the maturity dates and things like that. And so what this ASU did is it was very popular 2017-12. And it just said, you know what? You can expand this last layer method to include multiple hedge layers, right? So we're going to call it the portfolio layering method now, because now that portfolio of loans, maybe you can have one or two or theoretically infinite number of layers, right? Um, and so it also said, it doesn't necessarily have to be only used for assets like mortgages that can be prepaid. You can use this portfolio layer method for all financial assets. So it's just expanding that last layer method, right? Um, it clarifies certain types of hedging instruments, and the definition of a layer, kind of more technical things like that aren't as impactful. Um, Now, if you no longer anticipate that a hedge layer will be outstanding, like let's say it's been prepaid or you think it's going to get prepaid, then an entity is required to either partially or fully de-designate that hedge layer. So, which makes sense. Again, the whole point of hedging is you want something to offset something else. That's the whole point of it, right? So if that layer that you are hedging against is no longer going to exist, you think it's going to get prepaid or something, you'd have to de-designate some of that hedge, because you're no longer, say, going to be hedging $10 million of assets. It's only $5 million of assets or something. So you'd have to de-designate some of that, and that makes sense. Um, and then also the last thing here specifies how a hedge basis adjustment should be considered when determining credit losses. And so what that dealt with is let's say that you're hedging a portfolio that's got 20 different loans in it, and you need to spread that out. How do I spread it out, right? Do I spread it out over equally to proportionally to each of the 20 different assets I'm hedging, or is it just kind of a topside entry? And this specifies no, it's kind of a topside entry. You're not really changing the basis of any particular individual asset. So this had to be adopted for public business entities a couple years ago, and now we're just getting into it. Now it's required for public, should be private entities to be adopted. And with that, let's move into our third polling question, which is, have you experienced lost revenue after marking an acquired deferred revenue in a business combination, right? So this is just, as I explained earlier, you have to mark things to fair value. And so when you did that, sometimes the fair value deferred revenue was much less than the carrying value that you would have recognized under 606. And so that's what this is getting at. If you've experienced any of these questions, yes, no, don't know, what's lost revenue. So for those jokers out there, I'm sure you're going to say what's lost revenue. Hopefully, after this presentation, you'll at least know what that is. And hopefully, for many of you folks, you have not had any kind of losses. So give people a couple seconds here to answer that, and then we'll move into The ASUs that we're going to recommend you early adopt.
Yeah. And while everyone adopt, just friendly reminder, we're right here at the 45-minute mark. And I know we have at least, a couple more slides to get through. So we might press through just so that we make sure that we're getting everybody their opportunity to answer the polling questions and get credit, because I know that's why we're here for, as well as I'm trying to address the questions we're getting from the group, Michael, while you're going through it in the chat here. So if you have any questions in the chat, by all means, keep on sending them my way, and we'll get those addressed as well.
Excellent. So now we're going to move on to the third kind of phase of this webinar, which is the ASUs we would suggest you early adopt. And again, method to the madness here. We did the order, and the way we did is because we now have already talked about two of these, 2022-03 and 2023-02. So that only leaves four more that are out there that are not yet effective for private entities, okay? Right? Because we know that the audience is mostly private entities, so that's kind of what we focus on. So these are ones that aren't yet effective for private entities, but we would suggest you early adopt. The first one is 2023-05, and this one is joint venture formations, right? And so just to give you a little bit of background, a joint venture is literally when power is shared, right? 50% ownership, 50% ownership by two different entities. They combine to create a joint venture. A lot of times we use joint venture, in popular nomenclature, but it's not really a joint venture from an accounting perspective, which requires power to be shared. But if there is an actual joint venture created, there was diversity in practice. No one knew, well, what do I do? Like, do I treat it as a business combination and mark everything to fair value? Or do I just record everything at carrying value? What do I do here? And so what this ASU did is it clarified that for the joint venture itself, and I want to kind of emphasize that itself, they should measure everything at initially at fair value. But the investors, right? So the entity that's contributing 50%, they should continue to account for their contributions using the equity method, right? So I want to make sure that you don't start thinking you got to account for all your joint venture investments under fair value. It's the joint venture itself that needs to. Now, what I found really interesting about this issue is that goodwill could be recognized, right? So one, for those of you who might not be aware, if you have an equity method investment, that can create goodwill. That's something I've learned a lot of folks are not up to date on. But in this particular situation, you could also create goodwill because the joint venture is required to measure its net assets at 100% of fair value of the JV's equity, not the sum of the fair values of the individual assets and liabilities. So they have to go and measure the fair value of the whole entity, right? And then they allocate it to the different, individually recognized assets and liabilities, and there might be goodwill that's recognized. So I thought that was kind of a little interesting here, a little nuance. It requires certain disclosures, and it does not change the accounting for the joint venture by contributions made after formation. So after you form a joint venture, the joint venture itself does not account for all contributions afterwards at fair value. It's just that it's initial contributions. It's effective for joint ventures that are formed on or after January 1st, 2025. So it would be effective, say, for Q1 if you were issuing Q1. But for most private entities that don't issue quarterly reports, it's going to be effective for December 31st, 2025. But early adoption permitted. And the reason we're talking about it right now is because we are recommending folks early adopt that, because that is obviously where the accounting guidance is going. The next issue I want to talk about is 2023-08, and that one deals with accounting and disclosure of crypto assets, right? So crypto assets are, a buzzword. Everyone's interested in different Bitcoins and things like that. So what obviously is the prevalence of these things have grown. There needs to be some sort of accounting because there was no kind of explicit accounting guidance. And what this ASU does is it basically says that, hey, you're required to measure crypto assets at fair value with changes recognized in net income. Okay. Now they have to define a crypto asset, and this is one of those situations where you kind of know what it is when you see it, right? So the biggest thing I would say takeaway is that it resides on a distributed ledger or some sort of a blockchain technology. That's kind of like, in my opinion, the biggest criteria Everything else is pretty self-explanatory. It has to be fungible, that kind of thing. It has to be a moment, a type of money. Um, and so it also gives not just the, hey, you need to measure at fair value, but it also gives some kind of presentation and disclosure requirements, right? The presentation requirement for the balance sheet says it has to be separate from other intangibles, okay? You can't lump it in with intangibles in general. And along those lines, on the income statement presentation guidance, it also says, hey, that change in fair value that you're going to recognize for this, it has to be separated from other changes in intangible value. So like impairment charges and things like that. They basically just want you to call out crypto asset activity separately on the balance sheet and income statement. And then as far as the disclosures, the things that you would expect, the name, cost basis, fair value, that kind of thing. They want you to disclose the aggregate fair value of crypto assets that are not individually significant. So those that are individually significant, you list out the name, cost basis, fair value. For those that are not individually significant, you just do the aggregate fair value. You need to disclose the method for determining the cost. Now, when I first read this, I was like, what do you mean determining the cost? Well, I just whatever I paid for it, right? Well, what they're getting at here is just like for inventory, you might have LIFO or FIFO and determining, well, I have different Bitcoins that I bought at different times. Well, which Bitcoin did I just sell? Is it the one I bought, 10 months ago, the one I bought 1 month ago, right? And so that's what they mean. It's just the method for determining that. And so, there's some other disclosure requirements. For example, for annual reporting, you're required to disclose a roll forward. And now this roll forward requirement, the beginning additions, subtractions to crypto assets, that's only required for entities that actually kind of actively work in crypto. For those that maybe receive crypto, say is non-cash consideration, and they immediately convert it into cash, you're not required to disclose a roll forward here. Some of the other things, if you have a crypto asset that's subject to contractual sale restrictions, there's some additional disclosures you have to make. For example, like the nature and the duration of those restrictions, that kind of thing, and the circumstances that could cause them to lapse. This issue is required for annual periods beginning after December 15th, 2024 for all entities, public and private. And so this is technically not required to be adopted until calendar year December 31st, 2025. But again, I would highly recommend that folks early adopt it because that is exactly where the accounting guidance is going. The next ASU is ASU 2024-01, and this one deals with profit interest, okay? So give you a little bit of a background. This is really more impactful to like, say, partnerships, right? That generally are the types that issue profit interest, right? So the term profit interest is known kind of colloquially, but it's not really defined explicitly in US GAAP, right? And so, for example, it might be something that provides rights to future changes in fair value of the entity's equity or future dividends, but it's not something that is generally gives you rights to existing on day one net assets. And that's kind of generally the determining factor of whether something's a profit interest or not. And the real issue came up is that if I'm going to kind of skip to the bottom here. If why does it matter? Well, if you are a profit interest and you're not within 718, then you're in with 710. But 710 would more likely lead to a liability because you record a liability if something's probable and reasonably estimable. And so you would end up measuring it at fair value each reporting period under 710. So everyone's like, no, I want to record under 718, where you have it in equity and you kind of set it and forget it, that kind of thing. And so what this ASU does is it says, look, in order to be within 718, you have to actually issue shares, right? Or the amount of settlement has to be based, at least in part, on the price of the entity shares. Or again, you are going to settle by issuing shares. So you either issue shares or you have your value of what the holder is going to get is dependent, at least in part, on the price of the entity's equity. Right. And it gives a lot of different examples. And for those of you who maybe have already played in this space, there's a wonderful interpretive guides out there to kind of give you some helpful hints. What this ASU did is it really just kind of narrowed it down to really two criteria. Are we going to be issuing shares or promising to issue shares? And is the price the settlement is going to be based on is at least in partly on the entity's equity, right? And so what I've done here is included the examples in the guidance, and we're not going to go over them because I just want you to have them for record. I just want to point out to you that this very last one, which is case D, and this ultimately said, no, it's not within 718. All the other ones gave you examples of when it would. And so I'm pointing this one out because it said, look, you never get equity. So that kind of fails that first criteria, right? But then you could also still be within 718 because the value is going to be based upon the fair value of the entity shares. Well, it says here, no, this one's only going to be eligible to 1% of the preceding year's net income. That's not necessarily directly tied to the fair value of the company's shares. So it would not be within 718. So you'd have to account for it within 710. And so again, this one's effective for public business entities for this coming calendar year, 12/31/25. And for other business entities, it's for the 12/31/26. But we would recommend a yearly adopt. And the last issue that we want to talk about early adopting here is 2024-04. And this one deals with induced conversions, right? And so what it basically says is that when you have inducement accounting, right, why does it matter? You record the change differently. You just take the fair value of what the holders would have gotten versus what they did get, and that difference is what you record. When you have extinguishment accounting, right, the difference in fair value between the fair value of what you're giving them and the carrying value, which is usually much less than the carrying value of the old instruments, that's what you record as your gain or loss. And so people want inducement accounting because they get to measure the gain or loss differently. And this basically just says that, hey, in order to qualify as inducement accounting, you have to change conversion privileges, and it has to be exercisable for only a limited period of time. I want to say 60 days. Don't hold me to that. And then, of course, the debt has to be settled for consideration that's at least in value and form as what they would have gotten under the original agreements. And I want to emphasize that form part here because they give an example in the standard where, hey, we're going to give you for the next 60 days, if you convert your convertible debt into equity, we're going to give you much more value than you would otherwise, right? Than if you waited months to convert. And they give more value, but they give it, let's say the original debt would have been in a mix of cash and shares. Well, this new debt that we're giving you is being settled entirely in shares. Even though it's for more value, it's just in shares. And they said, nope, that doesn't qualify as inducing conversion because the form isn't the same as the original. So it has to still be a mix of cash and debt in this hypothetical. And so I thought that kind of popped out at me as to, oh, shoot, that's a little weird. So this one is effective for calendar year ends December 31st, 2026. But again, we would recommend folks early adopt that since it is where the standard setters are heading. With that, let's go to your final polling question here. And that is, are you interested in speaking with someone from Cherry Bekaert about implementing an ASU? We're here to help. We have lots of resources available and we have experience dealing with these ASUs. So obviously, if you're interested, we'd be happy to help you out. Give people a few minutes to get that last polling question in so you can get your CPE. Yep. In the meantime, if you all have questions that we haven't been able to answer, I know there's a lot to cover. I'm available and Alex is available. You can see our contact information there. And Alex, did you want to say something?
No, I was just saying, let's leave the last polling question up to make sure everyone gets the appropriate number of questions open. But thank you, Mike.
Yep. Excellent. Okay. So, yep, hopefully everyone's answered that. And on behalf of everyone at Cherry Bekaert and the whole team, we want to say thank you for attending this year's standards update. Look forward to seeing you next year, and hopefully you learned something. And if you have any questions, don't hesitate to contact myself or Alex.
Thank you, everyone. Have a good day.
Thank you.